Tax season is upon us and I want to save you the most money possible this year. So in this video, I'm going to be sharing with you 15 tax deductions and credits you may not know about that you can claim on your taxes, and one bonus one for this year. Hey guys, welcome back to my channel. If you are new, my name is Adrienne. I am currently studying towards becoming a certified financial planner, and I post videos every week on all things investing and personal finance so that you can learn to steward your money well. So with that said, let's jump into the video. I do want to add that these are the deductions that the IRS says that we can get. However, I would consult a tax professional or use TurboTax to make sure that you qualify for whichever deduction you think you may qualify. So I'm going to be sharing with you 10 deductions and 5 tax credits. So if you want to know the difference between a tax deduction and a tax credit, I will link a video up above that I did earlier for you to check out. So I'm going to start with the tax deductions. The first one is any charitable donations. Any donations that you make to a qualifying nonprofit can be written off on your taxes as a deduction. You can also subtract the value of any charitable gifts that you've given. So that may be if you donated clothes to the Salvation Army, or if you donated property, or you donated a car. All of that has a monetary value to it that you can deduct from your taxes. And you should have gotten a receipt when you did donate those things so that you could write them off on your taxes. The second deduction is mortgage interest. You can deduct your mortgage interest on your federal and state taxes, and this will reduce your taxable income by the amount of mortgage interest that you paid in that year. So for example, I purchased a home in 2020. I closed on my house in September, and for the year of 2020, I paid a total of about $1,900 in mortgage interest. So what that means is I can write off $1,900 from my taxable income when I'm doing my taxes. The third deduction is any qualifying medical expenses. That is more than 7.5% of your adjusted gross income can be written off on your taxes. The fourth deduction is the student loan interest deduction. So the student loan interest deduction acts very similarly to the mortgage interest deduction, which means any interest you've paid on your student loans, you are allowed to write off on your taxes as a deduction. There are thresholds to who qualifies for this deduction, so just make sure you consult a tax professional or you see what the threshold is to make sure you meet that threshold in order for you to take this deduction. The fifth deduction is any IRA contributions. So if you contributed to a traditional IRA, you are allowed to deduct the amount that you contributed to your IRA on your taxes. The sixth deduction is any 401k contributions that you made. That is any contribution you made to a traditional 401k or 403b or any similar account. And I believe the contribution limit for 2020 was $19,500. So you could have contributed a max of $19,500 to your 401k and write that off on your taxes. The seventh deduction is any HSA contributions. So an HSA is a health savings account. Health savings accounts are really cool because any money that you put into them are tax deductible, and any money you take out for qualifying medical expenses are also not taxable. If you qualify to have an HSA and you contributed money to an HSA, you can deduct the amount of money that you put into your HSA on your taxes. The eighth deduction I want to talk about is the home office deduction. So this one you would only qualify for it if you have a home office and you are self-employed. And that means that this home office is a part of your home that is only used for your business. The ninth deduction is the educator expense deduction. That is for school teachers or other eligible educators. That is a mouthful. Can deduct up to $250 on their taxes for classroom and school supplies and expenses. The 10th deduction I want to talk about is the tuition and fees deduction. And this is a deduction you can take for any paid education expenses, tuition or fees for yourself or a spouse or a dependent up to $4,000. You can take that as a deduction. Now I'm going to go into 5 tax credits that you may qualify for. The first tax credit I'm going to be talking about is the American Opportunity Tax Credit, the AOTC. This is an education tax credit that is per student for the first 4 years of their post-secondary education. So that means their first 4 years of college. For a total of $2,500, you can claim as a tax credit. The second credit I want to talk about is the Lifetime Learning Credit, the LLC. And this credit is a per family credit that is for up to $2,000 on qualified education expenses. These expenses have to be paid to a university. The amount you get to claim claim as a tax credit is calculated by 20% of the qualified education expenses that you have made up to $10,000. There are stipulations between the AOTC, the American Opportunity Tax Credit, and the LLC, the Lifetime Learning Credit. You can't double dip into both of them. So just make sure you do your research and figure out which one is ideal for you and which one is going to save you more money so that you can do your taxes correctly, because that is the goal. The third credit I want to talk about is the Savers Credit. The Savers Credit is a credit that is worth up to $1,000 for low and mid-income taxpayers who are contributing to a retirement account. And the fourth credit I want to talk about is the Mortgage Credit Certificate. And I've probably mentioned this credit like 112 times on my channel because I specifically got a mortgage credit certificate when I purchased my home. Some states offer tax credits on mortgages, and basically what that means is instead of claiming your mortgage interest as a deduction, as I was talking about before, you can claim some of it, or if not all of it, as a tax credit. And as I said in my tax credit versus tax deduction video, a tax credit is always going to be more beneficial and advantageous to the taxpayer. So if you can, always go for a tax credit. A mortgage credit certificate allows you to write off a portion of your mortgage interest as a tax credit. And the fifth credit I want to talk about is the Earned Income Tax Credit. And the Earned Income Tax Credit is designed to supplement the wages for low to moderate income workers. This credit can range anywhere from around $500 to around $6,000. And this credit may be available to anybody who last year may have lost a job, took a pay cut, or worked fewer hours during the year. And I know that may be very common for some people because of everything that happened with COVID. And the bonus credit I want to talk about that specifically had to do with last year in 2020 with regards to COVID is the Recovery Rebate Credit. So this credit is available to those who did not get the full value of the stimulus check that we got. If you did not receive the full value, you can take that as a credit on your taxes. And also as a bonus, anybody who did get the stimulus check, you don't have to pay income taxes on that check. Let me know which credits you are most interested in or which ones you know you are going to take. Let me know down in the comments below. And if you have any specific tax questions, let me know down in the comments. I would love to get into them and help you guys out since we are all in tax season right now. And thank you guys for checking out this video, and I will catch you guys in the next one. Bye guys.